Let's talk about Tesla's stock. We'll also review market forecasts, support and resistance levels in options, volatility, and trading volumes. But let's start from the beginning. After a 2-month period of consolidation, Tesla's stock price surged by 50%. Many thought we were on the verge of hitting new all-time highs, but that wasn't the case. Tesla's earnings report was disappointing, and investors didn't react well, causing the stock to fall back to where it started its rise. The stock failed to break through the $265 level, which has become a key resistance point, having been significant several times before. Tesla's stock has now dropped back to the $200 level. What's going on here? We've seen 2 significant dips of around 12%, followed by a further 20% drop over a few days before a slight recovery. This is undoubtedly connected to broader market declines and increased volatility. Now, let's take a look at volatility. When we examine the volatility skew, we see that for near-term expiration dates, volatility is skewed both toward downside and upside moves. However, for longer-term expiration dates, volatility is tilted toward downside moves, meaning put options. This is noteworthy. When we look at call options, which represent an expectation of stock price increases, we see a flat line, indicating that investors are not pricing in an increase in volatility for call options or an expectation of significant price gains. It's also worth noting that investors often hedge their Tesla positions by purchasing put options, which is why there is usually a skew between call and put options. Now, let's examine historical and implied volatility. Historical volatility, represented by the gray line, is currently higher than usual. I often say that implied volatility tends to revert to its historical values, but right now things are a bit different. I expect that historical volatility will gradually decrease, partly due to the recent increase in volatility. Tesla has experienced sharp price movements, with daily changes of 5 to 10%, causing historical volatility to rise. However, I expect it to decline over time. Finally, I want to remind you that you can trade not only the stock itself, but also volatility. Let me show you how this works so that everyone understands what I mean. You can trade volatility through options. We mentioned that volatility could decrease, for example, by 15%, and AI could calculate some strategies for us. Let's take a look at one of these strategies that's being suggested. We are advised to sell a call and a put option with a strike price of $200 for October and buy a call and a put option with a strike price of $200 for November. This is a complex strategy involving different combinations of buying and selling call and put options, as well as different expiration dates. However, I want to emphasize that this strategy needs to be actively managed. You need to sell options at the right moment and buy them at the right moment. This is just one way to play the volatility. Now let's look at the support and resistance levels to understand what's happening here. We see a significant imbalance, particularly in favor of put options. But let's start with call options. We observe that there is a large concentration of volume at the $200 level for call options. This represents significant resistance, which the stock has not been able to overcome for a week now. This resistance is partly due to these large positions in call options. Let me quickly explain how this works. It all comes down to the market maker. When you buy a call option, the market maker is obliged to sell you the call option, but they have unlimited risk. To hedge this risk, the market maker buys the underlying stock in accordance with the option's delta. This strategy is known as delta neutral hedging. The higher the stock price, the higher the delta. The higher the delta, the more stock the market maker needs to buy, which in turn pushes the stock price higher, creating a feedback loop. To avoid such a situation, market makers try to keep prices within certain ranges to also capture the premium. We can see what happens to a stock when a key level is breached. There was likely resistance at $190, then $200, and after that, the stock surged by tens of percent. Currently, the stock has risen by 50%. The same thing is happening here with massive resistance at the $200 level, followed by $205 and $210. If the stock breaks through these levels, there's a strong chance of a sharp upward move unless a major investor or fund initiates a large sale. Now, let's look at put options. Here, the situation is the opposite. We see that there's absolutely no volume in put options above the $200 level. There's significant volume below this level, but nothing above. This is an interesting point that I want to highlight. With put options, the situation is different. They are considered a support level for the stock. For example, at $200, we don't see the largest volume, but at $195, we do. This means that the stock tried to break through $195 several times, but failed. This is partly due to the large volume of put options at that level. By the way, we also tried to push today, but we bounced back. Where is the pendulum swinging? Also, I want to mention that we have $190 and $180. These are for put options. And now we find ourselves in a kind of a vise where call options don't allow the stock to move above $200, while put options don't allow it to move below $195. The stock seems to be stuck in this range, but I want to point out that sooner or later, the pendulum has to swing in one direction or the other. It can't be otherwise. Which side will win? It's hard to say, but based on the volume, I lean towards the downside winning at this moment. That is, the stock is likely to continue falling. Why do I think so? Because it has already experienced significant growth. If everything were fine, the stock could have continued rising. It could have been priced at $280 or $300, but as we can see, something went wrong. First, there was one big candle, then a report, then another big candle, and Tesla fell. This doesn't happen for no reason. Moreover, the sell-offs are happening on very high volumes, while the market itself wasn't particularly poised to fall. Therefore, the growth potential that we had has ended for now, but again, this is just my opinion. Now let's look at the market forecast. What does the market predict for mid-September? The market predicts a price between $195 and $200, which is the same range where Tesla is currently trading. This is obvious because September is just around the corner. Let's look at the end of the year. What is happening there? Here we see Tesla at a level of $180 to $190, which means the market is predicting a slight decline by the end of the year. Now let's look at mid-2025, and it looks even worse here, $160 to $170, indicating a further decline in the stock. Again, I remind you that we are likely to face turbulence next year. Markets will be fed, and a recession is likely to begin. But again, this is just my opinion. I'm not advising anyone to do anything, I'm just looking at the market, and it shows for many stocks that we will see a decline naturally. This is not happening for no reason. The market is pricing in some downward movement, and we will play accordingly. Now let's get back to Tesla stock. I remind you that I don't know how to predict price movements, and I don't know where the stock will go. My primary task is proper position management. I look at the derivatives market, at the options market, and build strategies so as not to lose but to earn. Let me show you one of these strategies. The strategy looks like this, for example. If Tesla stock rises to $230, we could earn $227,000. If the stock drops to $165, we would also make $27,000. If the stock remains at its current value, we will earn between $5,000 to $6,000, approximately within this range. However, if Tesla starts to rise or fall sharply, we might lose money. But again, I earn no matter where Tesla's stock goes. This is what I'm talking about, building positions wisely, and you will always be in profit. The options position looks like this, but again, this is purely for demonstration purposes. I won't open such a strategy, I'm just showing the management logic. Why? Because the strategy is complex and it can't be opened just like that. It requires management, buying options at the right moment, and hedging because you could face unlimited risk. It's very dangerous, and I must tell you up front that positions need to be actively managed, and you certainly need to be a professional. Based on everything said, I want to point out that during a recession or a significant decline, Tesla's stock might drop. It could fall to $100 or even lower. I fully allow for this possibility, but I also want to cheer you up. If you are a long-term investor, if you believe in electric vehicles and technology, then of course after the recession, Tesla's stock will eventually start to rise again. I can fully envision it eventually overcoming its historical highs and surpassing $400. But again, this won't happen quickly. It will likely occur after the recession. However, this is actually good. If the stock drops lower, you will have a great opportunity to buy an asset you like at a better price. I always take this approach: the lower the stock price, the better. The most important thing is not to overdo it and not to hold more than 10% of your portfolio in a single position, because if you have more than 10% in one stock, you could suffer significant losses if the stock starts to fall. If you have any questions, feel free to ask. Also, I recommend checking out my previous review of Intel stock. Good luck to everyone.